All right, can we continue? We are now looking at the third part of the learning unit. Remember, for the learning unit, just to do a quick recap, for the learning unit, we were expected to go through chapter 1 of Bando Yapadi. We were expected to go through chapter 2 of C.B. Joseph, and we also need to go through chapter 3 of Witzany as well. So we are also expected to go through chapter 3 of Witzany. And on section 1.6 there, the lecturer says, you must work through chapter 2 of the prescribed book with special focus on sections 2.1 and 2.3. Any additional information relating to the topics must be sourced individually to improve your knowledge of credit risk management. So familiarize yourself with the following diagrams, figure 2, figure 2.6 as well. And yeah, so that's basically what we need to make sure that we take note of as we go through the chapter on the book by Witzany. Now, chapter 2 of the book by Witzany looks at credit risk management. So it looks at credit risk management, and let us say we need to focus firstly the appropriate or recommended models of credit risk organization, as well as the separation of powers, both in the case of classical banking or corporate business activities, as well as the case of trading or investment activities. Those recommendations, in fact, go hand in hand with the Basel risk management process. Now, when it comes to section 2.1, which looks at the credit risk of the organization, they say the first and most important requirement for a sound banking credit risk organization is the separation of powers between the risk management and the business side. A possible organizational structure of a universal bank involved in commercial, corporate, and retail banking, as well as in the investment banking, is shown in figure 2.1. Now, if you check on figure 2.1, they give us a typical universal bank organization structure where we have shareholders and supervisory board, and then we have the CEO, and then we have the internal audit and control. And under them, under the CEO, we have different departments that report to the CEO, being the investment banking arm, the business division, products and market, IT, operations IT, and CFO, which is the finance side, and CRO, which is the risk management side as well. And here, on the risk management side, they say the credit risk, we also look at credit risk management, where you also look at business orientation, business origination, as well as product design as well. And here, this is where you look at credit rating, limit setting, collateral appraisal, credit approval, risk margin setting, credit monitoring, as well as workout and collections. And we're going to look at this in detail when we look at the credit process. Then we also, on the product design, this is where you look at the product and process risk assessment as well. So going back to the text, they say the risk management division of the bank is headed by the chief risk officer, who should be a member of the management of the board. So the business divisions, investment banking and marketing should report to other members of the board. Risk management is close to the finance and accounting sections of the bank, which are usually directed by the chief finance officer. The responsibilities of the chief risk officer and the chief finance officer can possibly be delegated to just one member of the board. Another controlling unit close to the risk management is the internal audit and control section, which stands above all the other departments and divisions in terms of control and auditing supervision. The independence of the internal auditing and risk management sections is often strengthened by direct reporting to the supervisory board, which acts on behalf of the shareholders. There is also a compliance department responsible for adherence to legal and regulatory requirements. If the bank belongs to a large banking group, then the chief risk officer is usually nominated by the superior risk management of the group and is only formally appointed by the CEO, which is the chief executive officer. So credit analysis, the setting of exposure limits, estimation of expected loss, entering the risk management calculations, and final transaction approval should be optimally done independently of the officials that take care of the client's business. So the important component of approval process is the assessment of collateral, in particular of real estate, which must also be controlled by the risk. So credit risk management may and usually does delegate certain limited approval responsibilities to the business units. So here, they also look at the credit process. But now, before we look at the credit process, which is also one of the very important concepts that we need to cover when it comes to preparation for the exam, reason being, the lecturer loves to bring question related to the credit process. Why? Because they can ask you and say, given an organization of your choice, can you analyze the credit process of that particular organization? But I'll also share a typical question that is related to the credit process as well after we go through the credit process. So here we are looking at the bank, right? Now, as we look at the bank, remember we said for a bank, the accounting equation of the bank says that assets is equal to equity plus liabilities. And here, when it comes to the assets of the bank, typically, this is where we look at the loans that the banks give to each customer, to each customers, whether it's an unsecured loan or different types of loans, like, for example, mortgage loans or vehicle financing loans, or these are the different types of loans that the bank invests in. So those are income generating, hence they are assets to the bank. And then we also have different securities that the banks also invest in as well. And then the financing of the bank is typically through ordinary share capital or whatever is owned by the ordinary share capital. And typically, we refer to this equity as capital. Then the liabilities is the debt that or the amounts that the bank is owing, and typically the debt would be money that is belonging to the depositors, and then there's also other forms of debt that the bank can also have as well, right? So this is the typical accounting equation when it comes to the bank. So this is the typical accounting equation of the bank, right? And remember we said, if you still remember in the previous class, we also noted that from these loans and securities that the bank invests in, this is where we find that this is where we need to make sure that we account for the expected losses. So the expected losses, we need to account for them when we determine the interest, the return or the interest that's going to be determined on these securities that the bank is investing in as well. So which means typically these expected losses, how we account for these expected losses is where we're going to say we account for these expected losses through we price or account for these expected losses by looking at the interest rate. When we say your nominal rate, the nominal rate, which is the interest rate charged by the bank to customers, is given as your real rate plus your expected inflation plus the risk premium. And this is typically how the bank prices for this expected inflation, and how the bank estimates the expected losses. So how the bank estimates the expected losses is where we say your expected losses or your expected loss is given as your exposure at default multiplied by your probability of default, multiplied by the loss given default, multiplied by the term to maturity of that loan as well. And this is how we estimate how much the expected loss is going to be. So how we estimate the expected loss? You are going to be estimating it using the expected loss calculation. And how we price these losses that we're expecting to encounter, we price these expected losses by ensuring that whatever interest we're going to be charging the customers there, it's already accounting for the expected losses that we're expecting to encounter as well. And please keep in mind that your real rate plus expected inflation is your risk-free rate. Now, how do we account for so now the question becomes, how do we account for the unexpected losses? So the unexpected losses in this case, we are going to account for, remember we said when we give these loans as well, we have expected losses that also emanate from this as well. And what also emanates from this as well is unexpected losses. So there's also unexpected losses that emanates from these income generating activities as well. So how do we account for these unexpected losses? By ensuring that we have enough capital to cater for these unexpected losses. So we need to make sure that we have enough capital available to cater for these unexpected losses. And how do we ensure that we have enough capital to cater for these unexpected losses? This is where we look at the base work codes. So the base work codes are mostly focused on trying to account for these unexpected losses. So the base work codes are mostly looking at accounting for these unexpected losses. So are we on the same page so far when it comes to the breakdown of where the losses are coming from and how we cater for them, and what are these losses, where they're emanating from as well? Ideally. Remember, in the previous book, when we're looking at Bandoyapadi, we did look at we were introduced to this formula, although we are later on, we're going to look at all these components of these formulas later on as well. But we were introduced to this formula in the first class that we did. Now, remember we said the bank is a financial institution. When it's giving out credit to these customers as well, the question now becomes, so what process does the bank or financial institution follow to when they are now considered giving credit to these customers as well? So you find that the typical questions that you usually would encounter when it comes to the typical questions that you would expect to encounter when it comes to the credit process is, let me just quickly look at one of the past question papers. Just give me a second. I'm just looking for a question where they look at the credit process. So a typical question that they would ask you in the exam would be a question like, remember, one of the learning outcomes in chapter 1 was being able to address the question, explain why credit is considered a powerful driver in the economy, right? So that's another typical question that they would ask you. And then another typical question that they can ask you in the exam is where they say, outline the credit process of your preferred lending organization, and in your own words, provide details of each phase. So normally they would not ask you to do this, but the most important, they say cut and paste from resources will not attract marks, which means you need to demonstrate your own understanding as well. So which means that's a typical question that they can ask you in the exam. If you look at this particular question, remember they say outline the credit process of your preferred lending organization. The reason why the lecture allows this particular type of question is mainly because this question is an open-ended question. Remember, your exams are now online, and to avoid having a situation where one student is copying another student as well, it means that since your exams are online, if they ask you to outline the credit process of your preferred lending organization, you are not all going to be having the same organization that you're going to be analyzing, one. And two, your analysis or the sequence of your analysis is not necessarily going to be the same as the next student as well. And because of this, that's why you see that these, when you look at the type of question that the lecturer brings in the exam, ever since the exam became online, these are the typical type of questions that the lecturer has to bring. Why? Because they are open-ended in the sense that they are asking you to choose your organization of choice. So when it comes to the credit process, we look at the review of the credit process. And here they say the credit process basically has 3 phases. So the credit process, remember when we talk about the credit process, we are looking at the process followed by a financial institution in giving credit to customers. To say, from the point where the customer shows or indicates interest in getting finance, and to the point where either everything is met or there is default that might also happen as well. So it's all part of the credit process. So here they say the credit process basically falls into 3 different and distinct phases: the credit origination phase, the monitoring phase, and the workout phase. Now, when it comes to the credit origination phase, under responsibility on who is responsible when it comes to the credit origination phase, they say typically in the credit origination phase, this is where you find the different business units, and this is also where you find the credit risk being looked into as well. Then from here, the key activities would be credit rating, evaluation of applications, risk-adjusted pricing, as well as collateral valuation. Then under the monitoring phase, remember all these phases, we're going to look at them in detail as well. Under the monitoring phase, the responsibility falls on the different business units, the credit risk, and also market risk as well. So this is where, that's basically where the risk is basically emanating from as well. And here, under the monitoring phase, the key activities are monitoring and identification of cases turning bad, reclassification or provisioning of bad loans, and then having corrective actions. Then when it comes to the workout phase, the responsibility falls on the parties responsible for debt recovery. And the key activities there is recovering of bad debts and also closing unsolvable cases. Now, looking at the credit process, they say the key role of risk management does not end with now looking at this, just to quickly go back so that we understand where we're coming from as well. They say credit analysis, the setting of exposure limits, estimation of expected losses, entering the risk margin calculation, and final transaction approval should be optimally be done independently of those officials who take care of the client's business. So an important component of the approval process is the assessment of collateral, in particular of real estate, which must also be controlled by the risk. So credit risk management may and usually does delegate certain limited approval responsibilities to the business unit as well. So here they say, when you now look at the credit process, they say the key role of risk management does not end with the approval and granting of a loan to the client. The overall credit process and the split of responsibilities can be schematically illustrated in figure 2.2. So corporate clients should be obliged to submit regular financial reports, which need to be monitored by the client relationship officials, as well as, depending on the size of the exposure, by credit analysts. If the reports or other information indicate a worsening of the client's situation, then corrective actions should be taken. The action may be the stopping of any new withdrawals, negotiation with the client on the initiation of early repayments based on existing contractual covenants, recommendation to change the current business plan, etc. So the last phase of the credit process already belongs to the workout phase when the exposure turns bad. Since the client relationship officials tend to underestimate the problems, the exposure should be transferred to a different specialized unit, which may be under the responsibility of risk. So the workout activities could also be under the business side management, but at all events, there should be a change of personnel and organizational responsibility in the case of bad client that is going through bankruptcy or restructuring. So the monitoring of retail loans is more mechanical and usually based on the so-called behavioral scoring. So the process of collecting retail loans with delayed repayments normally starts very early with the so-called soft collection method, whereby the clients are contacted by phone. It may end by the selling or outsourcing of the defaulted loans to specialized collection companies that initiate possible legal steps, the sale of collateral or execution. So provisioning is a very important part of the monitoring process. Provisions reduce the receivable net accounting value in order to reflect the expected losses. So the provisioning process is governed by international accounting standards or the international financial reporting standards, but should be in principle consistent with Basel 2 and 3 or the economic valuation approach. So provisioning is usually connected to a classification system, classifying performing loans as standard and watch, while non-performing or impaired are classed as substandard or doubtful, or and loss as well. So here they say, last but not least, we should mention the importance of data for good credit risk management. First of all, the bank should be able to filter out clients where there is serious negative information, including the bank's own experience from the past. For example, if a client engaged in a fraudulent activity when applying for a consumer loan, or his or her application should be automatically rejected if the client applies for a small business loan and vice versa. So this may seem trivial, but requires well-organized and interconnected databases covering all available sources of information as well. So which means going to our credit process there, we are saying the first phase is the credit origination. Now, the credit origination is basically that phase where we are saying from the first contact where the customer, the potential customer, is indicating interest in getting a loan until the loan is approved. So that's basically the credit origination. So everything that falls in between there is part of credit origination. To emphasize, remember I said, when you look at the first phase of the credit process there, it's credit origination. And we said with credit origination, it's all the activities that are involved from the point where the customer indicates interest in getting a loan until the loan application is either approved or rejected. And in the case where the loan application is approved, the second phase now becomes applicable, because over the life of the loan, there is need for monitoring and review of the credit that has been given. And so all these activities that are involved in the monitoring and reviewing of the credit that has been given, it's all part of what? Monitoring phase. Then in the case of default, so in the case of default, this is where the workout phase becomes applicable. So we need to find out exactly, so what is going to be the debt recovery and what is involved for us to be able to recover, and what do we need to put in place to try to recover these debts as well. And in the case of bad debts, how do we now treat these bad debts as well? So that's basically what is involved when we come to the workout phase. So which means
question related to that example you gave us, that exam question example you gave us. Will the lecturer expect us to know all of these things as per this diagram, but obviously applying it to the organization that you've selected? Like, is this the exact expectation?
So going back to the question, remember the question was saying, outline the credit process for your preferred lending organization, and in your own words, provide details of each phase. So which means you now, in answering this question, you now need to indicate, so ideally how you answer this question, right? First, you need to state the organization that you are analyzing. Secondly, you need to give a brief background of the activities of the organization that you're discussing, right? Then after that, you now need to go through these different, you now need to discuss these different phases: the credit origination, the monitoring, and the workout. And please note, these are the main headlines, but usually you find that what is involved under each one of these is very much dependent, and it varies from one organization to another organization. But generally, these organizations, they follow these three basic phases. So your discussion now on credit origination might differ from the next student as well. Why? Because different organizations, they have what? Different steps that they follow in the origination phase, steps that they follow in the monitoring phase, and steps that they follow in the workout phase. And that's why, most importantly, the lecturer says, if it's an assignment, if this question comes in as an assignment, you need to demonstrate to the lecturer that you conducted a physical visit to the entity, or even contacted what? A telephonic contact. So which means its originality is required, which means that if it's an assignment, you now need to show that who did you contact and what was the discussion, so that it shows that what you indeed did contact these parties as well. And cutting and paste information online is not enough, because they can quickly see it because of the issues of what? Plagiarism as well. So if it comes as an assignment, yes. If it comes in the exam, you need to show a general understanding of these different phases and the organization that you're analyzing as well. So you're not necessarily going to say, I did a telephonic contact or it was a physical visit, because remember, you are seeing this question as it comes in the exam. So which means you now need to show a good understanding of the credit process for the chosen organization. But at the same time, you need to show and demonstrate your understanding of the different phases and application of these phases to the unique organization that you have chosen as well. Are we on the same page? Any questions? Moving on section 2.2.
Rhinos, sorry to disturb. I have a question.
Yes, yes.
You mentioned the fact that in an assignment you would typically have to call or go physically consult, for example, a bank. Let's say you're choosing a bank, right? So what are the typical questions that you would ask and that you would need to have basically on your assignment? Like the typical general questions. I'm sorry if I missed that.
I wouldn't say questions per se, but I would say you need to show and demonstrate your understanding of what is involved when it comes to the credit origination. Because remember, you are discussing what you found out, and you are basically discussing the credit process, right? So you are now demonstrating to say, when I did the interview and I got the information, this is what is involved in the credit origination of that bank. From the point that the customer says that they want a loan, is there an application form that is filled? And then after that, what is involved? Who is involved? Do they do credit checks? Do they do credit checks? Do they do background checks? Do they look at the credit risk of the customer? What is it that they do as well? And how do they come about with the pricing system? Is there a system that they follow when it comes to the pricing system? And also you need to indicate of during the credit origination phase as well, what is the human input? What is the system input as well? And if there's going to be any collateral that is needed for the loans that are if one needs a loan, if there's going to be any collateral that is going to be needed as well, what is it? What is how much? How do they do the evaluation of the collateral? So you're basically discussing and giving the lecturer, demonstrating your own understanding of exactly the information that you've gathered up to the point where a decision is now made to say, is the loan going to be acceptable or is the loan not acceptable? And if the loan is acceptable, then the second phase kicks in. Then in the second phase, you need to now have gathered the information regarding the bank to say, so how do they monitor their customers? Is there a system that they use to monitor their customers? And how does that system basically work? So that's basically what you're now going to be demonstrating in the monitoring phase. And then in the workout phase, you're saying, in the case where the customer defaults on their obligations, right? What steps and procedures does the bank follow in trying to recover that money? And at what point do they now say, probably this debt obligation, this debt is no longer what? Recoverable as well. So that's basically what you need to demonstrate for each phase. So it's easier if ever this question comes in the assignment, I would always recommend that make it easier for the party who's marking your assignment to say origination phase, then you discuss the origination phase. Monitoring phase, then you discuss the monitoring phase. Workout phase, then you discuss, so that they are able to follow your arguments and your discussions as well. Are we on the same page?
Thank you so much.
All right. Now, moving on. On section 2.2, we also look at the trading and investment banking. And here they say, trading and investment activities should be, in principle, separated from commercial banking. There should be a Chinese wall preventing the investment part of the bank from using insider information obtained from clients in the classical credit process. Moreover, the monitoring of financial market instruments exposures is, in general, very complex and goes hand in hand with the ability to price and quantify the risks associated with the instruments. So they go on to say, the importance and difficulty of investment banking credit risk management is underlined by the bankruptcies of and huge losses suffered by the leading market players during the recent financial crisis. Remember, when they talk about the recent financial crisis, they're talking about the 2007-2008 financial crisis. So here they also say, even those that had been assumed to present the best practice in the markets like JP Morgan and Goldman Sachs, they also were affected as well. Then on section 2.3, we also look at Basel credit risk management requirements. Remember, we said when it comes to the Basel Accords, the Basel Accord is more leaning towards what? It's leaning more towards unexpected losses. And here they say the credit risk management organization principles are not only recommendations based on the author's experience, but also follow the Basel banking regulations. Before we point out the most important parts of the regulation related to the subject, let us firstly review the development and overall structure of the current regulatory framework. Remember, the Basel Accords, we're also going to look at them in a bit more detail later on in the chapter as well, in the curriculum. So here they say the goal of the Basel II framework, regulatory framework, is to set higher risk management and internal control standards for banks all over the world, as well as to introduce a new, more risk-sensitive approach to the regulatory capital calculation. So a brief overview of the historical component, or historical development in this case. So which means, please note that it's not necessarily important for us to know the historical developments on the Basel Accord. But remember, the main thing that we need to take note of here is that when you look at the Basel Accords, we are saying, so when you look at the Basel Accords, we are saying we are trying to determine to cover for the unexpected losses. So we're trying to cover for the unexpected losses. Then what covers for the unexpected losses? The capital. So which means in this case, we are saying the capital requirement. So the capital requirement. So the capital that we need to cover for these unexpected losses. Generally, in South Africa, we use the capital requirement is given as your capital adequacy multiplied by the value of your risk-weighted assets. And your capital adequacy in South Africa, unless otherwise stated, your capital adequacy as a percentage is 10%. But you see that in the textbook, they'll give you a capital adequacy. Sometimes they used 8% based on the US as well, right? But in South Africa, if ever you do this calculation in the exam or in the assignments, and they don't state exactly what the capital adequacy percentage you should use, you go back to the default percentage of 10%. So you use 10% unless otherwise stated. So which means you are saying from the risk that we're exposing ourselves in the assets that we're invested in here, 10% of these assets is the capital that we're going to set aside as what? To say, in case of unexpected losses, we have enough capital to absorb these potential losses. So the Basel Accords, the evolution of the Basel Accords is basically trying to find out exactly how much is the capital that we need to set aside to cater for these unexpected losses. Are we on the same page? So what they're explaining there, when you look at the evolution of the Basel Accords, the main or most important principle there is we're trying to cater for these unexpected losses. So Basel Accords try to address how much capital do we need to cater for these unexpected losses. So here, in the textbook, they go on to explain this, although it's going back to the principle that we've discussed there. And here they say, when you look at the brief overview of this historical development when it comes to the Basel Accords, although we're going to look at it in more detail later on, they say the first capital accord was officially published by the Basel Committee on the Banking Supervision, representing the regulators of the most developed countries in 1988 with an implementation deadline in 1992. The accord was amended in 1988 with the implementation, the accord was amended to incorporate market risk in 1996. At that time, discussions on a new regulatory framework had already started, and the first consultative paper was published in 1999. After receiving many comments from banks and national supervisors, a second consultative paper was issued in 2001. The new Capital Accord was finally published after long and numerous discussions, as well as a number of quantitative studies in June 2004. So the document was updated to incorporate certain relatively minor issues in 2005. A comprehensive version incorporating the market risk part was published in 2006. In order to put the new accord into practice, it had to be implemented into national legislation and regulatory frameworks. Specifically, the European Union published the implementation directive in June 2006. So the Capital Adequacy Directive had to be further incorporated into the national legislations within the EU. The Czech National Bank published the corresponding provision in June 2007. So the first year in which the new approach was fully applied by banks in Czech Republic, and similarly in other European countries, was 2008. The financial crisis, which began in mid-2007, have driven the Basel Committee to propose new amendments and modifications to the accord. The final version of the amendments to the Basel II framework, in particular in the area of securitization, as well as revisions to the market risk framework, were published in July 2009. So finally, in December 2010, the BCBS approved another reform of the framework based on Basel III. So Basel III does not change the approach to the calculation of capital requirements for classical credit exposures. It does, however, enhance capital requirements for market risk and introduces a new CVA capital requirement. For banks, the most challenging part of the new regulation lies in the strengthened capital requirements for the quality of capital and in introduction of the new capital conservative and cyclical measures. Other new important requirements are relatively simple leverage and liquidity limits, as shown in figure 2.6 for the more detailed overview. There is also an important shift in the EU implementation. The capital and liquidity requirements now take the form of a regulation directly applicable as a single rule book to member countries without national discretion, while the supervisory assessment principles remain in the form of a directive. And on the next page, they now give us the Basel. They give us the Basel III. Please note that For RSK4804, for the purposes of RSK4805, so sorry, for the purposes of RSK4804, you don't necessarily need to know the evolution of the basal accords as shown in detail here. You don't necessarily have to take that into account. What you need to make sure that you take note of there is basically why we need the basal accords. The reason why we need the basal accords is basically we need to try to find out exactly how much capital does the bank need to maintain in order to cater for unexpected losses. So now, what you're going to be interested in now for RSK4804 is now calculating the capital requirement. So when it comes to the evolution of the Basel Accords, the three pillars of Basel III and all those other things as well, for RSK4805, you are expected to know those things in detail. But for RSK4804, when you look at past question papers and past assignments, they are not necessarily expecting you to know the smaller nitty-gritties that are involved when it comes to the Basel Accords. The most important thing that you need to know there is why you need the Basel Accords and exactly how do you determine the capital requirement with regards to the Basel Accords, and also how do you determine the value of the risk-weighted assets with regards to the Basel Accords. That's what you need to worry about, and that's what you need to be focused on as well. These nitty-gritties of the evolution of the Basel Accords, I wouldn't really say spend too much time or too much of your time going through these other nitty-gritties when it comes to the Basel Accords, because I don't expect them to be asking you intricate information to say to indicate exactly how the Basel Accords have evolved from Basel I all the way through to Basel III as well. I wouldn't really expect them to be asking you this information in detail. Now, after this diagram, they also look at the issue of expected versus unexpected loss. So which means, remember we said here, your expected loss is calculated by this formula, right? So which means within the bank system, there's already an amount that you're also expecting to suffer as a loss. So the expected loss amount is expected to remain constant throughout, because already you already have a fixed amount that you're saying this is from the losses that we're expecting to encounter. This is the maximum amount of expected losses that we're catering for. Now, when the losses exceed the losses that you're expecting to encounter, the extra margin there is what we're now deeming to be unexpected losses. So this is what they're demonstrating there when it comes to this particular diagram. Because they are saying, when you look at the loss rate, we are saying your expected losses are those losses that you have already calculated and said, under normal circumstances, these are the losses that we're expecting to suffer. But in reality, over time as well, when those losses, or when your losses exceed those losses that you're expecting to encounter, that's when you are going to be having unexpected losses as well. So you see that when it comes to the frequency, you see that your expected losses, the frequency of the expected losses increase the more you are going to this amount as well. And then they start declining as well. The frequency starts declining, the more the higher unexpected losses also declines as well. So generally, we expect our losses to average out here. A lot of our losses, we're expecting them to be encountered here. And those losses which are more than these expected losses, we're expecting their frequency to be lower. And those losses which are below the expected losses, we're also expecting those losses to be lower as well. So that's what this diagram, figure 2.7, is demonstrating. Are we on the same page regarding figure 2.7? Any questions? Then figure 2.8 also gives us the distribution of these losses against the frequency as well. And as I've said, we said that your expected losses, these are the losses that you're saying, under normal circumstances, this is how much I'm expecting to suffer as up to this expected loss, which means that you would have already said on average, these are the losses that I'm expecting to encounter over this period as well. So which means you now look at the frequency of these losses as they are going towards the expected losses. Then those losses which you are now going to be, which you are saying are exceeding these expected losses, their distribution starts going down as well as they increase. So as these losses are increasing as well, their frequency is also going down. As we have seen there, the bigger the losses are, the lesser their frequency we're expecting them to be as well. Then now, when you now look at the unexpected losses as well, how we cater for these unexpected losses is where you are basically saying that, remember we said your expected losses, you're going to cater for them by using that formula which says your exposure at default, multiply by probability of default, multiply by the loss given default, multiply by the time to maturity. And this is how we calculate the total losses as well. How we calculate the expected losses. Your total losses you're expecting to encounter over a given period of time, you can also account for them using the value at risk. Because remember, by definition, the value at risk is the maximum loss you're expecting to encounter over a given period of time over a certain confidence level. So for example, you can say, I'm 90% confident that my maximum loss over the next 3 months is so much. So that's your value at risk. So the value at risk encompasses your expected losses as well as your unexpected losses. Now, remember we said when you calculate your value at risk, you're saying I'm a certain percent confident that my maximum losses over a given period of time are so much. If, for example, if you're 95% confident, it means you also need to take into account that there may be those losses which you might also incur, which are above the losses you're expected to incur, which are catered for using the value at risk. So you should also keep that in mind as well. So are we on the same page when it comes to figure 2.8? For Rsk4804, you are going to be doing these calculations, but you are not necessarily going to be expected to do the calculation for value at risk, because value at risk for Rsk4805, you are going to be asked to determine the value at risk, and you're also going to be asked to determine the expected shortfall as well. So here they say, when you look at figure 2.7, sorry, when you look at figure 2.7, they are now discussing what I've already highlighted to you as well. When you look at figure 2.7, they say the main guiding principle of the Basel regulation can be seen in figure 2.7. Banks regularly suffer annual credit, operational and market expected and or unexpected losses. The expected part of the losses based on the long-term history should be covered from annual revenues. The unexpected part, if not covered by the revenues, must be charged against the capital. In good years, the actual losses may be lower than expected, but in bad years, the bank needs a sufficient capital buffer. Hence, the goal of the regulation is to set up a procedure estimating the potential expected loss on a regulatory probability level. The task is mathematically depicted in figure 2.8, because now when it comes to from a regulatory perspective as well, that's where you're now going to be looking at calculation of the value at risk, where you're trying to say, so how much is the maximum loss I'm expected to suffer over a given period of time? Then that maximum loss minus my expected loss would tell me exactly how much roughly my unexpected loss would be given a certain confidence level as well. So are we on the same page regarding figure of 2.7 and 2.8? Any questions? So on figure 2.9, although you don't really need to spend too much time on it, they look at the cost of application or the three pillars regarding base. They look at the cost of application when it comes to Basel 2. So they also look at the cost of application when it comes to Basel 2, where you look at the first pillar of Basel 2 looks at the minimum capital requirements and how you set aside the minimum capital requirements when you take into account credit risk, operational risk, and market risk. Then part 3 is where you look at the second pillar, where you look at supervisory review process, and the third pillar is where you look at market discipline. Just take note of this, but I wouldn't expect for Rsk4804, the lecturer historically has never really asked you to now discuss the breakdown of the Basel Accords. Rsk4805, you are definitely going to be asked to discuss this as well, but not necessarily Rsk4804. So on this note, we are done with learning unit 1. So as you can see, if you check in your study guide, there are some chapters where you need to go through. You need to make sure that as you go through the study guide, follow depending on exactly what is being prescribed for you to go through for each learning unit. Don't just go through the textbooks. Go through the curriculum based on the information prescribed in the study guides. So there are some chapters where we go through all the 3 books, some chapters where we just go through 1 book, some chapters where we go through 2 books as well. So keep that in mind as you go through the curriculum. Are there any questions?
Question. Yes. So the first assignment is out. Will we maybe have time to go through that, or is that something that you won't be going through with us?
We assign usually, typically for Rsk4804, in some years they give you 2 assignments, but in recent years sometimes they give you 4 assignments as well. So for each of those assignments, we need to set aside a class where we are going to go through the assignments. So I'll make an announcement during the course of the week how we're going to be approaching each the assignment as they are opened as well. So I will make an announcement during the course of the week, when we're going to be looking at the assignments as well. So expect that announcement, because remember, I need to look at the questions first, then I'll know exactly how to approach those assignments. But typically, how we do it is that we set aside a class for each assignment that needs to be looked into as well. But the way that the class is going to be on the normal Saturday class slot, or in some cases, if it's a short assignment, we might even schedule a class to be done during the course of the week between 7 and 9 p.m. But don't worry about that for now. I'll need to look at the assignment, then I'll make an announcement on the group as well. Right. Is there any other question?
Audible.
Sorry? Is there a question? Is there a question? All right. If there are no questions, enjoy your weekend.